Hi, my name's Josh Bicknell from Balloon Ventures. We talk about ourselves as the first financial institution dedicated to good jobs. And we do this by helping SMEs to grow and create those good jobs in East Africa.
Welcome to the African Tech Roundup, Josh.
Great to be here.
So let's start with how a historian ends up working at what you deliberately call a financial institution in the making and not a fund.
Yeah, not a fund. This is all I've done actually out of uni. So I've never had a proper job. Never been employed. So I was studying history at Bristol and always studied a bit of kind of colonial history and the end of empire. And obviously being British, we're fairly linked into all of that. And then ended up in Vancouver doing a master's. And as part of that, went to Kenya for 2 months to do some research on the post-election violence, if you remember that, after kind of 2007, 2008. So I was there for a couple of months just speaking to people involved in it. And at the end of all of these interviews, people always said, have you got any money? I've got a business idea. And obviously at the time, I didn't really know anything about business or entrepreneurship because I was a history student and then politics. But came back to the UK, and at that time, kind of coming out of the financial crisis, there was very few jobs for young people, and everyone was talking about like how the UK should become more entrepreneurial. And so then that's where we had the idea of like, okay, well, maybe we could connect young people with some of these amazing like informal entrepreneurs in Kenya that are just kind of hustling, and they would learn from them. And so that's how we started our first programs. We got 6 kind of 18 to 25-year-olds. They went out to Kenya. They spent a couple of months working with like informal sector micro businesses, learning about kind of entrepreneurialism through that. And then that ballooned into Balloon and what we do today. And there's a kind of fairly long story of how we got from there to here. But yeah, that was the kind of seed of it.
Yeah, we'll get into that because that would have been a nonprofit at the time, right?
Yeah, that's right. Yeah. 2011, 2012 was kind of when we kicked off.
And so as a precursor to us talking about why you've since focused on boring businesses as this institution in the making, why is it an institution you go by and not a fund? What's with that distinction for you?
We've kind of dabbled between the two. I think the idea of a fund is like, there's a time period, right? I know that's changing in the world, but often, people have like a 10-year fund or a 12-year fund. And I think what we're trying to see is it's just something continuous. It's a way of investing in SMEs and trying to unlock their potential. But, I think often like the kind of language around all this stuff, as I said, me not coming from a finance background, I think sometimes it's semantics in some ways. And so we used to say, oh, does it really matter? Like, what's the difference? And I think now I've just realized that when people talk about institutions, you talk about something, I guess, a bit more permanent and a bit more long term. So that's how we talk about ourselves now.
And so that conveys your intent more than perhaps a time capped opportunity to extract value or get a project done.
Yeah. And I probably also, when we're raising money, that's what people understand better as what we do. So, a lot of this stuff is iterative, right? You talk about yourself in many ways over many years and you get to a point where people start to understand what you're doing and what clicks. And so yeah, that's us now. We're a financial institution.
Listening to you self-describe begs the question, what are your investment partners expecting and what are you selling them as a partnership proposition? But let's just start with the basics of what the business is today. What sparked this call, I think it's worth sharing with everyone listening, is a LinkedIn post you shared some weeks ago, which I quite enjoyed.
You commented on, yeah.
I commented on it, and it, and the rest, as they say, is podcast history. No, but seriously, it appears you as an organization have spent some time and effort to creating a dashboard that offers not just your team and your investment partners a view to the portfolio and how it's performing and the impact it's having in the spaces you've decided to work in, but also open sourcing this to a broader audience, including your boy on this call. What is it about the very specific portfolio of quote unquote boring businesses, your words, not mine, that warranted that level of sharing? And what's the intent and what's the outcome behind sharing so far?
So when we started working, we were working with very micro businesses. And we kind of got to a point and realized that like really what people wanted was a job. And things like microfinance are great, but they're just a sticking plaster. And so we started to look at like who could create these jobs. And in our portfolio of these micro businesses, we worked with like a couple of thousand over maybe 6 years. And we saw that there was like, 0.1% that maybe grew. And so we thought like, how do we unlock that group? How do we get them to grow? And so
At the time, you're dealing with people who are signing up as mostly solopreneurs.
Yeah, exactly. Like people hustling on the street, like market traders, people selling fruit, vegetable, clothes, things like that. So solopreneurs, which is like 75% of the Kenyan economy, by the way. So we just saw that as a huge public policy failure. Like people don't want to be entrepreneurs, right? There's maybe 5% of the population that should be entrepreneurs, but most really want a job. And yet because there's no jobs, we're forcing everyone down this route. And so we thought, like, how do you go about fixing that to create good jobs for, the bulk of the population? Because also the data is so clear around like good jobs, right? That like when you have a good job, so a job that pays well, that pays regularly, that's safe, secure, like that's when you begin to move, yourself and your family out of poverty. You begin to invest in housing and healthcare and education. It's that like certainty of regular money that enables you to do it. And 75% of people in the informal sector basically just trap 75% of the population going day to day. So we started to think like, how do you create jobs for that 75%? And we saw this kind of group of entrepreneurs like running like very, we'd call them boring businesses, but like very traditional brick and mortar businesses. Again, things you see on the street, like shops, schools, small clinics, pharmacies, things like that. But we started to look at, not the really micro ones, but those that employed 5 to 10 people. And we started to think like, how do you get those that employ 5 to 10 people to like 20? Because if you do that with enough, that then creates, millions of jobs for the whole population. And if you look at like larger economies, that's where people are employed, right? Like people are not employed in tech startups. They're employed in like these boring brick and mortar traditional SMEs. And they're not that sexy with investors because they all are doing very similar things. Problem is like people can't really invest in them because they need, an average maybe $20,000 and they're basically too risky to invest in. And so it's just the banks doing it. And as everyone knows, the banks don't like to take a lot of risk.
Yeah. And the cost of deployment must be a mission. Like getting the money where it needs to be and tracking it. And
the logic was that it's just not viable, right? Like people are doing microfinance, people are doing like big SME lending of maybe $1 million plus. And then there's banks. And then you have this like huge segment, which by the way, in Uganda is probably like $8 billion and is the same in Kenya and, and across sub-Saharan Africa is like hundreds of billions that just can't get money. And so that was really what we tried to go about solving for. Like, how do you get money to these businesses and how do you make this like a viable asset class? So we tested loads of stuff from like revenue share to profit share to equity to everything in between. And what we landed on was just a simple loan because that's what people understand and want. So our average loan is $25,000 for 18 months. But then what we do that's different is we bundle that with 6 months of business support that's all delivered in-house by our team. And so the idea of that is it reduces the risk of every investment. And then the third thing we do is data. So we're very particular about this in that most of the transactions in these businesses are cash and it's very hard to credit score cash. And so what we try to do is digitize the cash of these businesses, which builds up a database that you can use to underwrite future businesses. So we basically get good at doing one loan and we try and do that loan 100 or 1,000 times. And so we strip all of the complexity out of SME lending and then it just becomes a volume business. So how do you invest in, 200 SMEs in a month, for example? And then how do you go to 400 SMEs and how do you turn that around in 5 days? And so how do you take all of the complexity out of this? And that's why like boring businesses are good for us because we can understand them because they're all doing very similar things and they have very similar problems. And so you can begin to kind of productize and then, as you said, you can make it much more efficient and much more affordable to actually due diligence them and support them. So yeah, that's what we're doing. We've made about $15 million of loans so far. We're kind of roughly doubling year on year. When you talked about, are we a fund? We talk about ourselves really as what we're doing. It's a product or an asset class. So in the way that microfinance created like a product that means you could lend to micro businesses, we're trying to create that product that means you can lend to SMEs. And we're trying to grow that product in Kenya and Uganda and maybe one other. But this product could work in Mozambique or, or Zimbabwe and it won't be us doing it. We want others to do it. And so to come back to your question in a fairly long rambled way, that's the point of like open sourcing our data and creating these databases is to try to like prove that you can lend to these businesses viably. And you have to do something different, right? You have to add in business support and you have to use data intelligently. And it's not just doing loans. There's a whole nother kind of bundle to it, but you can do it. And through open sourcing that and sharing all of our data live. And yeah, we've open sourced our like post-investment playbook. Our end game is not us doing, $1 billion of loans a year. It's maybe us doing like $200 million of loans a year. And then all the banks doing the other 800 million plus. That's how we see this as the route that you get to scale.
And I imagine that accounts for your admission off mic the other day when we were chatting that the odds of an organization, even as advanced at working this model as you are, getting good at this model in every other market outside the ones you've already started to figure things out in are poor to low at best.
It just takes time. So I think, there's like 75% of what we do that is the same, because Uganda and Kenya are not the same market. They're different, right? And 75% of what we do in Kenya and Uganda is the same, but then there's 25% that's slightly different. Laws are different. The ways that people run their businesses are slightly different. So it's not that you have to create something bespoke in every single country, but it's that you can take a broad concept or methodology and then you need to tweak it for that market and that particular culture. And also so much of what we do is based around relationships. And I think that this is the other thing about SME lending, right? It's very hard to digitize writing a check of $50,000. Even for the entrepreneurs, they want to know you, they want to see you, they want to know that there's an establishment behind all of this. There's a lot of trust involved. And so that's where people and your relationship in the community and stuff is so key. And, that takes a long time to build. So I think it'll be easier for others to do it. But at the moment, there's very, very few trying to do this because it's seen as impossible. It's just seen as a loss-making venture, basically. And so we're trying to show that maybe this isn't going to make the most money out of anything you can do in the world, but there's a way that you can do this viably and you can have huge development impact. If people did this across the continent, you're talking about 100 million jobs. So that's the kind of scale and potential that these kind of boring traditional SMEs really have. And that's what needs to be unlocked.
Imagine a spectrum. On one end, call it the left. You the sometimes well-meaning but awkwardly negatively impacting left. This is my spectrum, right?
Okay, sure. Yeah.
In the far left, foreign aid. Coming right on that spectrum is impact investment of all kinds and non-profit-led, grant-infused, we're here to heal the world type energy. And then in the far right, on the other end of the spectrum, would be cold, hard capitalism, which is show me how this is going to make me more money than, I don't know, sinking another oil well in country X. And if you can't, forget it. My money is safer and growing faster and more fiercely doing X, Y, Z. I imagine you, and tell me if I'm wrong, I imagine what Balloon Ventures is being smack dab in the middle, but clearly consciously trying to define why you're not part of this nonprofit sensibility where you began, this charitable sort of momentum that perhaps got you started, but also why, on the other hand, as you alluded, you aren't all the way in the right of this is the easiest way you could invest and make a return on that investment.
So the continuum I kind of see it as is maybe less around your intentions, though that's obviously a big part of it, and more around what return you can make from what you're doing. So I'll see it as a return from 0% is you basically lose all your money, right? That's pure grant giving. And then 100% is you get your money back. And then maybe let's say, we talked about money and what the market wants. Maybe let's say it's 115%. So it's 15% return, right? Money is dumb. Money just goes for the prettiest thing, the thing that can make it the most money. And so you have to be as close to that as possible if you need money, because you need to get it, right? And so that's where we started. We started as a not-for-profit, and we just realized that it's very hard to grow that because there's so little churn in that industry. If you look at the biggest companies in the US, most of them are new, right? They came about in the last 20 years. If you look at the not-for-profit world, NGOs, it's all the same big people that have been there for 50, 60, 70 years. And it's so hard to get money as a kind of upstart. And so that's why we kind of became a bit sick of it. We were doing something that was working, but we just couldn't raise any more money to scale. And then we started looking at what was going on in the venture industry, and you see there that there were new people coming and they were getting a lot of money quickly. And so I think that's the thing, if your venture or whatever you're doing needs money, you need to get as close to this really pretty thing that money likes in order to attract that capital. But then I think what a lot of people don't accept is there's a trade-off. Not everything can make the money that money wants to invest in it. So if I go from this 0% return, which is just you give it away, to 115%, which is you're making market rate return. Acumen did a really interesting report recently on their learnings of 20 years. And they were basically making a 90% return. So for every dollar that was invested, they got 90 cents back. but there was a huge amount of impact there, right? So you start to play like, okay, that 10 cents that they've lost, or the 10 cents plus the 15 cents return, like, is that worth it for the 10 million, 50 million, 100 million, whatever jobs, people that they've provided electricity for, all that kind of stuff? I think that's what's often missing in this game, that there is a trade-off, I think, very often between like return and impact. And so we're not going to solve all of these huge problems that, many of which are getting worse, by the way, in the world, through like maximizing return, because that's what's got us into this mess in the first place. But that also doesn't mean that like you need a 0% return, right? Like maybe you can do the Ackman model when you make 90 cents of every dollar. For us, we're trying to get as close to that 15% return, because that's how you get the $100 million or $200 million that we need to do all of the investments that we want to do. But we're also aware that like the more profitable we get, there probably is a trade-off in terms of impact, right? Like, there's a really interesting one is like just demographics that you can or can't invest in. In our portfolio, we see young entrepreneurs generally are a bit riskier. They pay slightly worse, like the slightly high default rate. So if you're looking at that purely from like a profit maximization point, you'd say, okay, we're not going to lend to like young people. I mean, that would be a crazy, crazy decision, like considering the demographics of Africa, but especially Uganda, for example. So if we're just driven purely by like how you make the most money, you're really going to have to reduce the impact that you're going to make. But similarly, if you just think about impact, you're not going to probably get enough return. So like you're always trying to balance the two. And so I think that's what we're trying to do. We're trying to get as close to like market returns as possible. But, the more affordable the capital, the more blended you can get along the way. That means we can do more impact. And so that's what we're trying to preach. And so the things like publishing our data and our impact and our dashboards, like, there's some people in the world that are willing to pay for impact. There's not enough, and hopefully there will be more. But by being really transparent about like what the impact is that we're creating, like hopefully we can crowd in more of that alongside that capital where they're simply looking at like, how do I make the most money?
Which brings us nicely to this question of, I suppose, incentives and who you're packaging this asset class product for.
Yeah.
And maybe that's where I struggle sometimes. Granted, I'm not quite in your position. I'm not like running a financial institution or a fund per se. But, coming out of VC, I think what struck me, having worked in VC for nearly 3 years, what struck when I read your share was just how fundamentally contrarian it is to the proprietary, almost sometimes zero-sum sensibilities that tech VC, particularly in Africa, as collaborative and almost kumbaya as it is relative to other parts of the world. But even relative to that, your sensibility around, hey, as part of building this product that is demonstrative of broader value that we could create if we did this en masse and not just us doing it, it becomes really difficult for me to sort of divorce intent from the sources of the money that might show up to do either impact or blatantly just try and get a return on the maximum possible return on what they've injected.
Yeah.
So then how do you think about that product and who it's for then?
Well, just jumping back to VC though, people need to realize it's a crazy asset class. You're basically hunting for billion-dollar businesses, of which there's very few. So generally when you're due diligencing, like you can only invest for stuff that can make crazy, crazy, crazy returns, which is fine. Like it's a good asset class, but there's a very limited number of those businesses. And similarly, that's not what Balloon is trying to do. Like when we speak to VCs about investing in us, like we very quickly realized that like we don't fit within their portfolio because we're not going for this hyper growth and hyper scale.
And you're trying to be around longer than maybe a 7 or 10
exactly.
years
It's
of
like
cycle.
you're trying to build something lasting. I say, going back to that point of an institution. And what we're doing takes longer to scale. Like it's very easy to loan money and very hard to get it back. And I think a lot of VCs that have invested in lending businesses that are scaling super fast are realizing this now. Like it's easy to show metrics on like capital dispersed and it's much harder to get it back. So you've got to be like careful. And also if we're investing in a segment that people think is like unviable, we can't just say like, oh yeah, we can grow 10x in a year because it doesn't fit, right? It doesn't make sense with like, why is this so hard? And then you're growing this fast. So
who's the product for, this asset class you're building or you're trying to prove out, this hypothesis about this? And then maybe link to that, why share and how does that sort of drive product adoption and product market fit?
In any financial institution, you need money because that's basically what you're doing. You're buying and selling money. And so in terms of who's it for, like, we're an upstart on the block, right? We're still small. And as I said, like we're doing something that's seen as like crazy hard. And so you have to like build trust and confidence. And so I guess.
And by the way, contextualize small for us because, that's relative too.
Our loan book now is like $7 million. A lot of the development finance institutions and stuff would maybe start looking at us at like $15 million portfolio, but, a reasonable sized microfinance in Uganda might have a portfolio of like 50 million to 100 million, say. So
the irony, though, in terms of like impact linked to that, as humble as it sounds in the way you've just framed it, I think I read you say that your portfolio's turnover represents around 8% of Eastern Uganda's GDP.
The kind of 500 odd businesses we have in our portfolio, their annual turnover is about 250 million a year, which, as you said, is about 8% of the GDP of Eastern Uganda, which is a crazy stat and shows one thing about like how underreported GDP is, but also shows how much impact you can have just amalgamating these boring SMEs and actually how much impact they do have. And that's just one stat. There's also like 60,000 students are in the schools that we fund. The healthcare facilities provide services for nearly 1 million people. Just in terms of cheaper goods and services, stuff like having cheaper hardware products to build your house, for example, or cheaper food products. You're looking at over 1 million people that these businesses serve. So yeah, they are boring and people generally don't look at them because of that. They're not doing something innovative and shiny and sexy and new. They're just doing things that people need and work.
So no AI then.
There's a bit of AI in what we do, but I mean, we'll still see how effective that is. But no, there's definitely. But no, you're right. Like that's a really important point. These businesses are like, they're hardly digitized at all. And I know you're interested in this idea of the tech world kind of meeting like the offline world.
Yeah.
Most of our clients don't even have laptops. A lot don't have smartphones. If they have smartphones, they might be only running like a couple of apps like WhatsApp or something. They're not really interacting in the digital world, and they're definitely not getting a $25,000 loan in the digital world. I feel everyone's so obsessed with like technology because it's a really cheap way to scale. But if that's just where the majority of consumers are not at, then you're excluding the majority of people if you're not going to be where they are at the moment, which is like still face-to-face, relationship based. And then similarly with cash, 75% of transactions probably in our portfolio in Uganda are cash based. In Kenya, which everyone thinks is like everyone just trades in M-Pesa, it's still like 40 to 50% of SME turnover is cash. So if you're not figuring out a way of like understanding what the cash flows are and kind of underwriting this cash, you're just missing like such a huge segment of the market. That's what a lot of people are doing. They're fighting for these existing data sources, of which there's not that many still, right? And I guess what we're trying to do is like build our own data source, which it just takes longer. But like once you have it, that's something that's very powerful. So going back to sharing, it's like, yeah, we're trying to share like what are the turnover of all of these different businesses? How do the different sectors look? Which sectors are growing faster than others? Which sectors create the most jobs? Which sectors create the most jobs for like women and youth? Like what's the pay differential for women in different sectors? What does our like portfolio look like in terms of sectors we invest in? Because, we're just tracking really like what the biggest sectors are in an economy. Like all of that data it's how we make good decisions. And I think trying to share that with people and show that like this is maybe one of the missing pieces, right? Like building those data sets, like using them intelligently. And so I guess going back to sharing is like, we want other people to do this, right? Like, because our end game is not to like dominate the market. Our end game is to try to crowd in others. And that's very different for investors, right? I guess like, yeah, our investors don't want us to dominate the market. That's not the investors that we get into Balloon, and that never will be. Like we're getting those in that want, they want their money back and they want a bit of return, but they want impact. That's the reason why they're willing to like subsidize or haircut a little bit off that return.
Playing into that spectrum I proposed earlier, most people on the further ends of that spectrum I described aren't ready for what you're describing, because the current incentives for the sort of fund dynamics and investment mandates that they're currently pursuing don't lend neatly to what you're proposing and what you're currently working on. Or leaning into intent, maybe from a policy perspective, like maybe a geopolitical sensibility and foreign policy perspective, there's quote unquote what good looks like in terms of doing what's good for Africa if you're America or the UK or Europe or whatever, or Russia or China or whatever, that doesn't quite necessarily map neatly to what the continent needs.
Yeah.
And maybe a third, just quite frankly, that data desert that you're slowly but surely addressing in your sort of unique little corner exists across the board, in which case no one is confidently asserting new ideas or finding new paths in the absence of data that hasn't yet been captured and organized as neatly as you're starting to do.
Yeah, and I wouldn't say it's Africa. It's like, it's almost any impact business, any business that's trying to do impact as a core part of its business model. Like, yeah, there will be some where you can make market rate returns, right? Maybe you're, someone like Patagonia, right? Where you can price up your bags because you're selling to like a a wealthy demographic that are willing to pay. So yeah, if your customers are willing to pay more, then fine, you can make market rate return. And maybe in carbon because it's traded potentially, and maybe in bits of energy because people pay a lot of money for energy, obviously, right? Some of the biggest companies in the world. But in a lot of stuff, when you're talking about like healthcare, when you're talking about education, when you're talking about like food, other basic services, like this isn't just Africa, this is everywhere in the world. It's very hard to make market rate returns off a lot of that stuff. And so I think, we can broaden this and just in terms of like, say, getting to net zero and, fixing the climate, but also biodiversity and all this other stuff. I don't believe you can do that at the current market rate return because the market rate return is based on like exploitation of resources and generally of people. And so if you're not going to exploit, this is another LinkedIn post that got quite a lot of debate, but like, this is me coming at it from studying history and politics. I don't really understand finance. I'm dumb in finance. I'm just kind of observing what I see around me, right?
Joshua, you know a thing or two, but I take your point though. I take your point.
I'm just seeing stuff like, this is just what I see that like, as I said, money is dumb. It just goes for like where it can make its return. Like the problem is that return is too high. Let's say for investing in SMEs or microfinance in Africa, let's say it's 15% in dollars. You add in FX of 10%, you're at 25%. You then end up lending to SMEs at 40%? But SMEs have a margin of 5%. SMEs just can't afford to do that. And that's even worse, say for, I don't know, it said, youth-owned businesses where they have a higher rate of default. Beyond what we do, that's the same for so many business models. We're just trying to play a small role in trying to say that impact costs money. And there doesn't have to be this left and right, as you're talking about, just giving money away on one hand and on the other hand, like maximizing return. But what if in the world, instead of saying, we want 8% on all of our money, we'll say we want 5. At 5% return, maybe you can move 1 billion people out of poverty. You can get to net zero. You can do all these wonderful things. And it's that margin of 2 or 3% on cost of capital that means you can't do it. That's kind of where we've got to. And so we have to raise money at slightly subsidized rates or get it blended or get people to put in patient money and, linked to other more high return funds, because that's the way that you invest in this asset class of SMEs that, don't make that much, they're not that profitable because the barriers to entry are so low and they're not making crazy money, but they are great businesses employing lots of people, providing basic goods and services that everybody needs. And so we have to get money to them, but how are you going to do it?
So here's the thing about impact, though. I mean, I was watching the Harry Stebbings interview. I think he was interviewing the Shane CEO, who made what on the surface might appear to be a fairly compelling argument for how positively impactful Shane is for the world in light of how the efficiencies they're bringing to the market in terms of allocating just-in-time, on-demand based, delivery of clothes to who wants it. Is relative to the quote unquote wasteful status quo that has come before it. I share that as a almost tongue in cheek example of just how wide and broad the definition of impact and the impact we want is in the world right now.
Yeah.
How do you frame for yourselves the kind of impact you think is worthy of, one, the efforts, you and your team want to continue to drive, but also in making a case for this asset class and people who might buy in? How are you framing that impact?
And I think just on your first point, I think that's a massive problem because everyone's kind of preaching this, you can have your financial return and you can have impact. And so the people that distribute money and make decisions are kind of sitting there thinking maybe there isn't a trade-off, Harry Stebbings and 20BC, right? Their goal is to maximize profit, but the World Bank, the European Investment Bank, all these institutions, it's not. But people there think the same thing, or from a lot of the conversations I've had, this kind of asset class of social investing or impact investing, whatever it is, when there's so many people preaching that there's no trade-off, people start to believe maybe there isn't a trade-off. That's not their fault. That's just kind of what they're hearing as a narrative. And then you have so many people, therefore, you have to promise that you can deliver the returns that everyone wants.
Right.
And you get this inflation of promises, but then no one meets that. And then everyone starts to think, investing in Africa is a really bad deal because no one's making the returns that we were promised 10 years ago when we created these funds. I think that's maybe what we're trying to bring, a kind of dose of realism to this. And that's where the data helps us, because we can say this isn't me just being difficult. This is literally me just showing you all the data points from $250 million turnover segment of SMEs and the margins they're making and the jobs they create, and do we think this is worthwhile to invest in them? Yes or no? And this is how much it's going to cost. So going back to us, what we think about, impact is such a broad, maybe unhelpful term, but we talk about good jobs. So for us, a good job is one that pays a living wage, one that is contracted, so there's job security, and one where there's like ongoing training and development. And so we did some work with 60 Decibels on this, and we spoke to a lot of people in the portfolio, and yeah, like those three things were dominant across gender, age, geography, country. That's what people wanted. They wanted the job that pays well, that's secure, and where they're going to learn and develop.
And that's kind of a hot take in some circles as well, where obviously the entrepreneurship gospel is being sold as a sort of vehicle of choice in driving impact, in the sense that when you look at the informal economy in a country like mine, in Zimbabwe, how many people are by default entrepreneurial or entrepreneurs, whether they define themselves as that or not? The sensibility is, hey, let's get more people doing that. And I think
that's a bad thing, right? Like if you have an economy with 75% of people are entrepreneurs, like that's not good.
I think an honest, introspective listener right now would have to admit that most people they know across the spectrum of society in almost any country on the continent would favor a job over starting a business.
A lot of people don't accept that or come to realize it. Like if you think about people listening to this, how many people really want to run their own business and have the stresses of that and the uncertainty of when you're getting paid? Entrepreneurs, it's a specific, I can't remember what the research is, but maybe it was like 5% of people have these like traits. And also it's based on your background, right? Do you have a mortgage? Do you have a family to support at that time? Like the kind of the whole situation that you're in. Do you have a propensity to take risk? And generally, if the answer is yes, you become an entrepreneur. But the idea that like all of these people that have no safety net and no propensity for risk are being forced into running small businesses because there's no alternative. That is, like, in my view, one of the biggest public policy failures. It's not just Africa, by the way. It's across like, many emerging markets, and it's becoming more, in the UK where I live, like there's more people that are going into this because there's less safe, secure, formal jobs for them to be in. So
let me push back as well and say we've never had more examples of how relying on quote unquote the job delivered by quote unquote the system, of how people who orient in that way are let down by the system, or their hopes dashed by basically not focusing on what they could do for themselves. I think maybe that's the other oversimplification in this debate, where the job is representative of a loss of agency, a sense of helplessness, or an infantilization of an individual in a way that basically 5-10 years down the line, they're very sorry they put themselves up for.
I mean, we just came at it quite basically. Like we spent 7 years working with these micro entrepreneurs, solopreneurs, people trading, and spoke to lots of them and said, like, what do you want? And most people would said, I want a job. And the guys would say, I want to wear a tie and a suit every day and go into an office. And, the ladies similarly, probably not in a suit and tie, but, smart clothes. But there was some that said, no, I want to be an entrepreneur. I love it. But that wasn't the majority.
As a share of your portfolio, who ends up in the bucket of the true entrepreneur by that classic definition? I actually want to run a business. I want to be a boss. I want to employ people. How much of that do you think, organically becoming part of what you back versus what you described prior? I
mean, because our model is a volume. It's like we have to take a quite basic approach to it. So we just look at the number of employees. And generally, if you have like 3 to 5 full-time employees, you've stepped outside of that like micro level and you want to grow and you want to do something. That's what we look at. Like if you're still running a business and it's just you probably can't afford the amounts of money that we're trying to lend, because our minimum is about $10,000. But also, like, as a proxy for, do you want to be an entrepreneur and grow a business? Like, are you employing other people? Because we're like a volume business, we're not that fussy. We want to do lots of deals. Like this month, we've done about 50 loans. We see a business, and like if you fit within that and you want, and you agree to work with us around improving the quality of jobs that you offer, because that's also a big bit. This is the other bit around money that's interesting. It's like money has an amazing ability to move people because people want money. And so we force through some of what we do through our loan terms. So we say, we'll give you a loan, but we want you to move all of your employees onto contracts, because we see like 98% of people, even in these like SMEs, don't have contracts of employment. And a contract of employment is the first step into having a good job, because it gives you legal protections. It gives you security in your work. And so we say, okay, we're going to give you $20,000 loan. We'll give you $10,000 now. And when you've moved people onto contracts, we'll give you $10,000 more. And it's amazing how quickly people do it. Like we used to take the other approach that we'll give you $20,000 and then we'll try to convince you to do it. And 4 months later, you're still fighting with people, right? That's like the power of money. You can move people because people want it. And so that means you can move people in a positive direction. And you can apply that to any use of funds, right? Like whatever the impact is or whatever it is you're trying to create, you can do that through through the terms that you set for your money. And our funders do it as well, right? Like the DFIs that fund us, the organizations, like they'll have requirements. And
they're not exactly saying, hey, here's money, do what you like.
No, absolutely not. No, very much the polar opposite of it. Yeah, very much the polar opposite. But I think that's often the thing that people forget about money, that it can really drive behavior change in a positive way.
Always strings attached.
And if those strings are right and they're clever, then you can create a lot of positivity.
Joshua Bicknells of this world, who hopefully are people of conscience.
But we're seeing it more, right? You're seeing like finance linked to impact. You're seeing impact bonds. You're seeing slightly lower requirements based on the impact that you create. Like I think the world is.
But you're also seeing a lot of people, greenwashing. You're also seeing people like wrapped over the knuckles. It's also never been a wilder west, as it were, in terms of storytelling. I mean, everyone's in the impact game now. If the CEO of Shane can jump on a podcast and wax lyrical about how impactful they are for the world, I mean, it does require us to spend a little more time kind of defining what good
100%.
looks like and what it
100%.
is. Like.
I was at like a really large impact investing conference. A lot of people will know, and I won't talk about it, but there was like one of the world's biggest investment banks there and one of the world's largest private equity funds that, they're generally not the good guys of capitalism. And if they're at an impact event running sessions there, you start to wonder, like, where has this really gone? And that's the bit that we really fight back on, this kind of idea of like, you can have your cake and eat it, you can make as much money as you want, and you can change the world, you can fix all of these problems through profit maximization. Like, for me, that's like one of the most dangerous narratives at the moment. And I think that's the bit we have to fight. And sure, there will be some businesses that can make a load, and maybe the one that you mentioned is one of them. Maybe you can make a load of money and you can have a load of good positive impact on the world. But there's a lot where that doesn't work, right? Like agriculture is a huge, smallholder farmers, who we need, by the way. They're not going to be able to give you your like really high market rate return, probably. But do we need food? Yeah. Do we want them to protect the land that they're on? Like, yeah, of course we do. So you got to like come to other solutions.
I think what enabled the conversation was the transparency.
Yeah.
On your side, I may have heard of Balloon Ventures, and I certainly didn't know as much about the specifics of what you're learning, both from, success and setbacks. It also provided like a proxy for you to start to unpack the oversimplifications that ironically might be in your best interest to continue to engender if all you were interested in is landing your next check or your next investment partnership, etc. And so I think there's an intentionality that I just want to, be grateful for here in saying, look, you got the conversation started, and maybe the challenge to other investors, come institutions, come funds, who might, to be fair, because they're in different sectors, might feel the need to be a little more proprietary, based or, zero-sum focused. But honestly, I think in the long run, no one wins at that game. And I think it's this level of baseline transparency that I hope becomes the status quo mainstream in your business and in other sectors and other asset classes as well.
Yeah, we need a bit more honesty, I think. And I understand where it comes from, because everyone like beats their chest and says, oh, look at how great we're doing, because that's the game you're in. As an entrepreneur, I do it loads, right? Like, you have to kind of inflate what you're doing.
Our impact is better than theirs.
Like you have to, because everyone's like, you're like everyone else is doing it, so you kind of get pulled into this game, and that's fine. But there also needs to be a bit of like honesty as well around some of this stuff. And I do think this honesty around like how much money you can make through doing things that are very, very hard is like one of the most important discussions to have. And yeah, if people want to see some more ranting on LinkedIn, then you can come and find me.
You're actually really great to follow. I can wholeheartedly endorse following Joshua Bicknell. You'll find his links in the show notes.
Or Balloon Ventures as well. We're looking for investment all the time. So if anyone listening with some money, yeah, maybe you don't want the most profit, but you want some, then we're here for you.
As we land this plane, as it's clear we are now, your most vigorous pushback for almost everything you've said here today, the asset class you're trying to build, the reason you're sort of open sourcing, your learnings and the data, your commitment to this particular area of entrepreneurial opportunity and backing it with investment, your sense of how we can't always have our returns and impact to, or have the highest possible outcomes on both sides of the spectrum without basically losing our minds or basically being dishonest. Putting that in a big neat ball and thinking about this one time where you made this proposition and you got this unpleasant and violent pushback from a would-be prospect. With that in mind, what would you want them to know and anyone else who might be inclined to think like them?
No pressure.
No pressure whatsoever.
I think like the stats are just massive. People talk about $400 billion that's like missing from SMEs in Africa. Like, think about that. That's a lot of money. So that there's a lot of return that people can make there. Yeah, I'm not going to say you can make the hugest amount of profit, but like that's a massive opportunity, right? Just financially. And then think about jobs. Like you're talking about like 100 million jobs here. And then think about like the turnover of all of these SMEs. As I said, like the turnover of ours now of 250 million. Like we're just getting started. Like that's thing already like 0.5% of the GDP of Uganda. Like, you know, in a couple of years, that's going to be 10% of the GDP of Uganda. Like it's just clear that there's like so much potential here. And I think sometimes we overcomplicate development or, you know, impact and things like that. Like at the core, people need money to survive, right? And where do you get money from? Generally, it's from a job. And so like, that's what we need to give people, like jobs. That's the keystone for everything else in the world that follows. Of course, you need like a functioning government, but beyond that, like, yeah, if you want education, if you want healthcare, if you want a good house, if you want to provide a good standard of living, like you need money and that comes from jobs. And so like, let's not overcomplicate this so much. Let's think about like where the most jobs come from. And it's not going to be like venture-backed businesses, you know, which are fantastic, by the way, but generally like the model that they have is efficiency and trying to reduce the number of people through tech and all this kind of stuff. Jobs come from boring businesses. There's a lot of them in Africa. Yeah, let's try and get some money to them.
That's as a decent an argument as I ever heard. And thank you quite a bit too for leaning into our very specific interest on African Tech Roundup to kind of focus on how this quote unquote digital economy is intersecting with the real economy, as it were, which it's sometimes frustrating to see how people don't even acknowledge exists anymore, which is crazy. But yeah, I really do appreciate this chat, and all the best to you and the team at Balloon Ventures. May the money that's due to you flow at leisure.
Nice one.
Thanks again, Joshua.
Thanks for having us.